because I nailed what is a pretty simple idea for a lot of people in our live stream on the Small Exchange YouTube channel earlier today, but it's one that I think is worth harping on, and one that I think is worth going back and forth in your mind on and getting people like your opinion, Pete. I mean, you've been trading since the 90s. You've seen almost every day of this movement in the S&P 500. And I really like here in 2021, more than 30 years later, to try to, drill all of this trading down to one number or a couple numbers. And it is this idea of like, people invest in stocks. It's almost unanimously the first thing people do when they open up an account at Robinhood or at, Interactive Brokers or at what is becoming quickly one of the most popular places to trade here, Tastyworks. The first thing that they do is like, oh, I'm supposed to buy stock in here. And you might think like, man, why is this? When you take a step back, it's like, why is buying stocks so popular? Oh, because it's worked more than 80% of the years going back to the 90s, right?
Unbelievable. Yeah, absolutely. And I think, Frankie, it's also, there's a connective tissue. I think, you tend to trade stocks that, number one, all the elegance of the way they're quoted, all that other stuff, but they're available everywhere and they're companies, which means you allegedly understand what they do. I think, in fact, many of us don't. But I think everything that is interesting to trade is something that I feel I understand. And, you can look at a lot of products and say, I don't understand what that is. It's a different world. So, sure. But, you look at this movement and this is, again, it's like I want to go on double in my shorts just looking at the chart.
It is pretty wild. And, for the purposes of today's conversation is, looking at just the simple idea of longing stocks and growing your account with futures and the efficiency that growth, that futures kind of inject into that stock growth. But yeah, it is funny because I was putting this together and I'm looking at this S&P chart and I'm like, man, for this 80% number to continue, and for numbers like this, where the average return, Pete, is close to 10% now, going back to the 90s, for those numbers to continue in this chart to look similar in 2025 and 2030, it's almost like it's got to be like, it's building, hyperbolic move. And then like it almost is going to start failing. I forget what test it is in math theory, but like the chart is going to start going backwards on itself if it continues with this growth, like it's going to go from being concave to convex, and it's going to be growing so fast. But let's just live in the here and now. And this is also a really interesting number because one of the last times I thought about the average annual growth in the stock market, Pete, was when I was at Merrill Lynch Wealth Management. And when I took that picture that you love so much, where I look absolutely miserable in my suit and tie. And I just remember every fund that came in the door that tried to pitch themselves to the wealth managers I was working for, everything was, average return of the S&P 500 was like 6.8%. And we beat that because of X, Y, and Z. That number now is 10%. Yeah. Unbelievable here, Pete, at 10%. This is another reason why stocks are so popular, right?
Well, yeah, absolutely. And the trade-off, savers in this country, whether you're putting your money in a bank or buying treasuries or whatever, are actually receiving a negative return. Here you show a 9.7% growth in your investments. There, over that 10-year period of time, that 1.3% yield on treasuries, if inflation's anywhere where we are, you're actually at the end of 10 years down 6%. So, yeah. You look at that and you start to think about context, and is this overdone? Well, as a contrarian, I kid, but it seems the parabolic nature of this. But then you look at the comparable suite of offices of offerings in the world of investable assets, and it doesn't make this right. It's right because this is where it is right now, but it makes it very interesting. So,
well, to me, it's always like, you have to deal with the numbers you have today. Like
Exactly.
when you start to create strategies and create, I mean, we talk about it here internally at the small exchange, like, oh, what if we created this product and then in a year from now, X, Y, and Z happened? And it's like, that's great to have foresight and to have, predictions and projections. But what I can act on today in the next 10 minutes has to be a function of what I have at my disposal. And right now, and it's not like I'm cherry picking the last
No,
couple of
not at
years
all.
here. Since 1990, the average return is almost 10%. And this is amazing for large accounts. And this is the really nice thing, but also what a lot of times there's so much commentary out there, which I think is really justly posed, which is like, wow, the wealthy just keep getting wealthier because it's easy to have, 100 grand, 200 grand and build your wealth, build your retirement, feel comfortable based on just passive investment here. You don't have to do a lot. Whereas the small traders out there, the small account holders,
That's an interesting point, right?
they have to pull a couple tricks out of their sleeves to get there. And that's why, we've created this community for not the people. I mean, of course, if you want to trade small exchange products and you want to, scalp and build your wealth and you have hundreds of thousands, even millions of dollars at your disposal, yeah, we pose a lot of great advantages to that large account. But it's even more particularly the small account of 5,000, 10,000, 50,000, getting near to $100,000 there. That's what we created products for. That's what we create strategies for. Because if you've got 100 grand or 200 grand, you're stacking up a pretty nice chunk of change passively, right?
Absolutely. And I think your maintenance-free aspect of an investment is an interesting non-barrier to entry. So, there's always a trade-off. There's a trade-off in life.
Yeah.
I could work with Glenn or work with you. You do a good job on the slides. But Glenn is Glenn. So, but yes, absolutely. So let's talk about the complement, though. True product indifference means we're willing to look at and weigh the lift of new product adoption versus the benefits. And I think that's where we're going here.
And what's really nice is that commentary of like, the wealthy used to be the only people who had products that they could access or had wealth managers that they could access to get at least that growth. Here in 2021, any account size, even down to a few bucks, $100, thanks to places like Tastyworks and Robinhood and on down the line, like they can access that baseline. But let's not get it twisted. Like if you access this passive investment and you get that average, 9.7%, it's the same as the large account there, the $100,000. But Pete, like less than $500 a year over the course of, a decade, even 2 decades, isn't going to be enough for you to comfortably retire or buy that retirement home or condo or, make a comfortable amount for you and your significant other to get out of here on. And that's why you try to grow this account. And I don't mean to scoff at it because once again, 9.7% is great, but it's going to take a while for you to grow that smaller account to a place where you can comfortably retire, right?
Good point. Absolutely.
Yeah. And so that's why we look for, some kind of lift to these returns. And a lot of times for us on this show, Pete, it's strategic lift, it's getting us strategies that like, okay, this is going to win more often than the general stock market. But today I wanted to just give this idea of like, you can win as often as the stock market. We have stock products and you can lift that return and enhance your expectations little by little, thanks to futures. And of course, I spoke to this, while giving this presentation. You don't want to go full boat. Like that's where futures go wrong, right? Pete is like, I've got 5 grand and I put 5 grand towards 50 grand worth of stocks in the market. And let's just hope these next couple of months go well. But what's really nice is that you can get that stock exposure and then you can get exposure so many other places thanks to futures, and you can enhance your expectations and get close to that large account's growth in a small account.
Yeah, absolutely. And that's, I like your terminology. It's again, we're trying to be as efficient as, boy, that's such a word that's so beat up, capital efficiency. But that's what we're trying to do, is be efficient with our use of our greatest constraint in life, which is capital, whether it's investing, living, or whatever. It's a great constraint. So how do we use it efficiently and effectively? And I think that is an important part here, because you're looking at kind of the same chart here, Frankie, just on a percentage basis versus a nominal basis. So how do we go back and take a look at that? And I think this is where it's another great introduction to the discussion of, okay, the world I'm in, the world I can go to, and what's the lift and bridge to it. So you're laying out the foundation here wonderfully.
Yeah, because those reductions in cost, a lot of people, think about it for a second. Oh, futures, instead of paying 50 or 100% for stock exposure, I can pay less than 10% with the small exchange futures products here. And it's like, oh, do I really need it? Maybe not. I'll just stick with what I know and what I have. But Pete, those reductions in costs go a long way here, because as you can see here, if you do go full boat and you have a $5,000 account, you commit all of that to stock exposure using stock futures, then your expected return from given historical data is nearly doubling that account every year here. And that's when you can at least get a little bit closer to what has been reserved for those large accounts in the past, which is just like higher returns, getting closer to $80,000, $90,000, whatever you deem as a retirement fund there with enhanced returns. Now, of course, once again, we don't advocate for levering up the full account, but it's really nice to say, I've got $5,000, I can get more than $5,000 worth of stocks with one future that costs me, $600, $700. And now I have still 80% of my portfolio to do whatever I want with to create even more returns.
That's a great place. There's your tradable takeaway: is the leverage is an efficiency tool, not a gaming tool, so to speak. In other words, I don't want to go, I don't need the $50,000 worth of stock with, I don't want to use all that capital. I love the fact that you're talking about how this fits elegantly into a smaller size portfolio, really expanding. I would say, gee, Frankie, honestly, 15 years ago, nobody really was interested in taking a futures account that was less than $50,000. Even 10 years ago, it was $25,000. Now you're seeing the ability and efficiency of smaller size futures opening that door. Not in a bad way, not saying, hey, we're going to let the casino open to a different audience, but really let the marketplace use the efficient products built for the appropriately sized trader. And that's really what we're talking about here. So it's a great discussion. And it's a great way to walk us through. Well done, my friend.
Absolutely. Thanks so much for joining me on this topic of growth in your small accounts with futures. Appreciate it as always, Pete. And we have some time to jump into the platform. We're going to be doing splash into futures coming up next. Some markets starting to move a little bit. Got to be picky on an inside day like this, but we'll find some trades for you. Thanks everybody for watching. See ya.